Dunstan McNichol, you were talking a little bit about the movement of assets into the hands of various investor groups. In the past, they used to simply be run by the investment council staff, investing money. Now you're talking about money that's going into professional investment houses, hedge funds, and whatever.
And the staff of the investment council actually did an amazing job when you think about it. There was a statistic put forth by the head of the investment division in November. He said that each of the employees in the investment council is responsible for managing $4.5 billion in assets, which is it'd be hard to sleep at night these days if you had that on your hands. So part of what the state was trying to do was to get some more expertise in there, to get into areas that, and one individual with $4.5 billion wouldn't have the ability to size up adequately. And so they basically outsourced that.
And their salaries are nowhere near what people make who do direct those types of resources. No, they're not getting the big bonuses you read about in the paper, or even a
anything
percentage
like
of
that.
what
they're getting
what other big pension systems get.
No, they had to pass special legislation to let the director of the Division of Investments get paid. I think it's about $240,000.
Yeah.
So yes, their salaries are not. They're more than you make at McDonald's, but they're a lot less than you make at Goldman Sachs.
Comparable pension, not Wall Street, but the comparable pension funds.
I'm unfamiliar with the other
California,
state pension
New York,
funds.
Massachusetts.
Yeah.
Okay.
But the way they came more into line with those high-profile pension funds, like the California pensions funds, are the biggest public fund on earth, and they are very active in terms of imposing their social priorities on the companies they invest in, because they're a gorilla out there. They have a lot of sway. They also are very prolific users of private money managers and investment funds. So it's not unusual that New Jersey would have started. New Jersey was really one of the only major public funds that didn't use outside managers. And even today, they don't use them to as much and as an extent as a lot of the larger companies. Their problem is they started using them at a time when, to outside appearances, it looked like they're looking for some magic bullet to try and beef up the fund.
Increase their
and they insist that's not the case. They say, no, it's just a lowering of risk and spreading diversification into areas we don't have expertise. But it's hard to get away from the notion that they were hoping that this was going to bail them out.
Was the Lehman Brothers investment one of the first where they went to these managers?
No, Lehman Brothers actually was an in-house decision. That was one made by the investment division itself. Their thinking at the time, which was back in June, was Lehman Brothers is hitting a rough patch. Lehman Brothers has been a company for decades. We know how they work. We like the managers. We like their style. This is going to make us a lot of money.
So they invested in the stock, not as managers.
Right. And then obviously the company went bankrupt and then the stock became worthless. So they lost $115 million. There's a lot of questions about that now. The head of the Division of Investment says the questions are not fair. It was a bad call. They wish it had gone otherwise, and it didn't. Now I think there's going to continue to be a lot of questions. They're going to get second-guessed a lot more than they ever did.
Because of the general decline of the market that's affected all of us.
And because by not putting contributions in, the state basically as a policy was relying on the market performance of the funds to carry the load. And as a policy, that has proven to be a disaster. So everyone is now questioning, well, who's deciding who's putting us in the market? Yes, at the November meeting, one of the newest members on the investment council, which basically is an umbrella oversight board that says, yes, we want to put this much in alternative investments, and yes, we want to put this much in real estate, and yes, we want this much in stocks, but they don't say we want this much in Sears stock and this much in Home Depot. That's up to the division. Anyway, the newest member is a former Communications Workers of America local president. CWA is the largest state workers union. They've been opposed to the whole use of outside managers from the get-go. Their concern was that the state loses the ability to head off disasters, and it's going to become politically motivated. So
But if you don't use outside managers, and the average person, as you said, has to really invest over $4 billion, unless you're simply indexing, following the prescribed benchmarks, how can you not use outside people?
Well, and there's an argument to be made that why not just index? You know, that this is a big pot of money. Statistically, it's probably going to go up and go down pretty much in tandem with the overall market anyway. So is it worth getting into all these controversies?
There's a whole academic literature. There's a whole academic literature that shows that essentially the yield is pretty much the same in the long run. If you had simply gone with the market, gone with the indexing, than if you hired people to play. And
and that's a policy decision. It's a policy decision.
But shouldn't you have if you're really running? I mean, at one time the pension system hit $86 billion. When $86 billion was $86 billion.
Yeah.
How can you possibly manage that with a small staff that's underpaid? Don't you have to go?
Then you're pretty much hoping that you find the good stocks at the right time, and
we
put a big chunk of money in them.
We all do. We'll come back to that in our conclusion.